All right. All right, so we're on air now. I'll go ahead and I'll read the prompts here and we'll get the conversation started. All right, so the first one is about value and goodwill, and the prompt is, let's see here. Okay, I'll just read the whole thing. It says in Chapter 10, the authors present an argument about goodwill, saying some accountants have argued that any goodwill should be written off when it is acquired, because it would then receive the same treatment as inherent or internally generated goodwill. In the article, A Case for Brands and as Assets, the argument of contradiction or double standard is presented. However, in the article, the author writes from the position that internally generated intangibles, specifically brands, should be recognized as an asset. What are your reflections on these viewpoints? Anybody want to start? I guess I'll go ahead and start by saying I think that I think that it is appropriate not to recognize an intangible when acquired, especially if it's goodwill, because there's a lot of intangibles and a lot of other qualitative aspects of a business that aren't recognized on the financials when they're acquired. One of the main reasons that companies are acquired is because of the leadership and the people that are in the business. Yet on financial statements, we don't quantify for human capital. We don't quantify for that type of competitive advantage. It's just inherent and it's just intrinsic within the business. So I don't think that goodwill should be recognized when acquired. And besides that, the value of goodwill is not to the company. The value of goodwill is to other people outside of the company. And so to value goodwill and to keep it on the books is does no service for the company, because it's really not those internally that are affected by the goodwill. The goodwill is the reputation that others have of the company. The goodwill is not something that's going to bring as much competitive advantage if others aren't involved. So if that makes sense, yeah, I don't think that it should be accounted for when acquiring. So that's my 2 cents. Anybody else want to step in?
Do you agree that it should be, accounted for, like in the article said, that it should be, they should have like brand recognition and stuff like that?
So are you asking if I think that it should be accounted for in the disclosures? I was trying to understand. Is that what you said?
Well, really, the article wanted, you know, the first one, the book wants it to be on the balance sheet, and the article really wants it to be. Did I flip that? No, yeah, no, yeah, the income statement. So I'm basically asking you, should I don't want to put it. Because I feel like they're different approaches. So the article wants it to be one way, and the book wants it to be the other way. The book says write it off, and the article says, actually the opposite way. I'm sorry. The article is going to be a balance sheet approach, and the book is an income statement approach. Do you think it should be on the balance sheet, or do you think it should be on the income statement, or you think it shouldn't be accounted for at all?
I think it's hard to know how to account for such an intangible when there's a lot of intangibles that aren't accounted for when you acquire a business. So I would say that I definitely don't think it should be on the balance sheet, because on balance sheets we reflect assets, liabilities, and equity, and I don't think that goodwill. It, I think goodwill has economic value. In that sense, you can call it an asset, but at the same time, it's not something that would really materialize for a company until that company is sold. So I definitely don't think it should be on the balance sheet, and I'll say that much. Anybody else want to give their viewpoint?
Yeah, I had a professor who called it not goodwill, but badwill. He said that if you're recognizing goodwill, it's because you paid too much for your company. Uh, but I think that if your intangible asset can be reliably measured to generate cash flows in the future, I don't think it should be written off right away when you buy it. The text makes it clear that this is true for service industries, and I think that service industries are a big part of the American economy. But the response to the text, the article about the contradiction, said that if a brand is should be recognized as an asset, I think that you could do that if you can prove in the management discussion in your statements that the relationship that the brand has with customers has been proven to be powerful to generate cash flows and increase customer retention. And I think if you can make that case, I think you should count your brand as an asset on the balance sheet.
I think the other thing that the article mentioned is the inconsistency of you put it on the balance sheet if you require it, but internally generated intangibles aren't recorded. I do agree that they have a point that it should be they should be the same, so it either should be on the balance sheet for both, or you should not put it on the balance sheet. But I think a good point that they made was it's really hard to value internally generated intangibles. I mean, I think even at the end of the article, like, I think the author said that while he agreed it should be the asset, he didn't really have a set method to record internally generated intangibles. So I think they should do something about the inconsistency and do it one way or the other, but I think it'd be really hard to value the internally generated, and it also kind of opens the door for kind of manipulation of how companies come up with that amount.
One thing the text mentioned is that on the balance sheet it would show up as an extraordinary item, and where we're doing away with extraordinary items, that creates a problem because it's going to be treated either as a infrequent or a unusual item, and it can be it's up to the preparer to put it basically where they want to put it, which creates more availability for manipulation. When it comes to, I do think that a brand in theory should be an asset, but as it's been mentioned, the valuation of it is difficult. I found this article from the Journal of Business, Finance, and Accounting that discussed accounting evaluations during football player contracts. And I honestly don't know very much about football, but I took it and I related it to basketball. Like, if you take LeBron James, he was drafted from the Cavs. I mean, that's kind of, in a sense, internally created. How would you value that for the Cavs at the time versus when you go and trade a trade and you get a player? I mean, that creates a whole other valuation problem. But in that sense, for the teams, how would that be valued, I guess?
I wanted to say, to add to that too. I don't think that, so if goodwill assets, whether internally generated or acquired, aren't recognized on the balance sheet, that doesn't mean to say that they don't have value. That doesn't mean to say that they don't contribute to the buying and selling of whatever the company is in business for. I just think that showing it on the balance sheet is not necessarily, well, another reason, it impacts the ratios that investors can calculate, that you can, the ratios that are calculated based on those balance sheet financials. And so if it's not possible to take that out, or if it's not possible for some companies for those who do generate goodwill internally to show the same type of goodwill, it definitely throws off your ratios. I don't know enough about basketball to answer that question specifically, but maybe somebody else does, and if not, then we'll move on to the next question. All right, let me go ahead and find the next question for us. All right, question 2. Some primary business risks that Novastar faced included competition, loan quality, loan sales, and holding loans on the balance sheet. As part of the investment decision process, investors will identify business risks and rely on information found in the financial statements to assess the risks. Which accounting estimates allow you to assess Novastar's business risks? Let's start with that one. Anybody have an answer for that one?
I have here, and it's just the values to get to the fair value, is the discount rate, the prepayment speed, and the credit loss assumptions, which also affect the sales accounting that they're heavily reliant on. Not sure if anyone else has any other.
I'll add that on, let's see here, what page is this? So on page 5 of the article, it does say that that he believed that Novastar manipulated its earnings and its balance sheet through the assumptions that they made. So I guess the first step that I would take in assessing or using accounting metrics to assess the risk is to first identify the assumptions underlying the decisions that management's making. I work in forensic accounting. That's kind of the I guess the part of accounting that I work in. And what we do a lot is when we're assessing other experts' reports, we take an approach that attacks the assumptions that they make in those expert reports. And that's exactly what he was doing in the article. Is he first identified what those underlying assumptions are, and then he would challenge and track those assumptions to try to see if management was manipulating those because they impacted the financial statements. For example, in the mortgage sales, all right, let's say here, it says, in mortgage sales, fair value estimates were greatly influenced by management's estimates of the discount rate, prepayment speed, and credit loss assumptions. So to go back to the question, which accounting estimates would allow you to assess Novastar's business risks? You would use those metrics that allow you to understand and to track their discount rate, prepayment method, and credit loss assumptions. So is the discount rate appropriate? Discount rates are always determined based on the risks of that business. So is the discount rate that they're using similar to what other businesses in the industry are using? Is the prepayment speed? So we could look at day sales and inventory and other metrics that have to do with receiving money and the speed at which you receive money. And then the credit loss assumptions, maybe what their write-off rate is compared to other companies in the industry. How do they compare? And basically, the approach that we would take is to identify those assumptions and then attack those assumptions. So, anybody else have anything they want to put in?
Yeah, just to piggyback off that, I know that what the main character in this article did was kind of look at overall market forces and saw that if interest rates were rising, they didn't estimate any of their assumptions. They just he saw that they were kind of sort of just manipulating those assumptions to get whatever earnings that they wanted to present on their balance sheet or on their financial statements. So I think definitely looking at market forces, rates, other kinds of data that's going on all around the markets should give an indication of what kind of business risks that they're undertaking and should allow you to assess how well their assumptions are and how well they're performing.
Yeah, I had the same 3 assumptions they noted. It was the discount rate, prepayment, and credit loss. And it was interesting that in the case they said that they kind of manipulate this based on the interest rates changes in order to like keep their revenues flat. So I think they said when the interest rate went up, they decreased the discount rate and then decreased the loss assumption so that their revenue wouldn't go down. They keep it consistent. And another metric to look at was the impairment loss that they recorded, because that basically tells them how accurate their initial assessments were. I think there was one case where they said they recorded this revenue, and then a year later they recorded a big impairment, which showed that their estimates were completely off.
Yeah, I came up with the same thing you guys did. I think the big thing for these, and this will probably segue into the next question, is the ability for these companies to be able to benchmark against other companies in the industry and even themselves with the impairment issue. And if they're having to go back and change estimates, or they are outside of what the industry is doing, which they were, I think that's a huge red flag that shouldn't be ignored.
All right. Anybody else have anything before we move on to the next question? All right. Here we go. All right. So how do you think Novastar performed based on these accounting numbers?
I think it would come down to your definition of form. If you're just looking at it, you're just like a financial statement user, and you look at it, you'd say they perform very well because you're taking it, I say, at face value. Where someone like, man, I've already forgot his name, the guy in the Novastar article, he basically had a lot of industry knowledge and industry experience, so he knew, these metrics don't stand up to the industry, historically, and competitor, as competitors too.
All right, let's go on to the next one. All right, so the last question is, what is your assessment of the SEC's and analysts' response to Cohode's, I hope I'm saying that right, to his research? Your response.
Reading this article made me think of the guy who contacted the SEC about Bernie Madoff. I think he did that over a span of several years, and the SEC just ignored him, even though he was able to prove that Bernie was realizing gains of, I don't know, 10% return on investment at a time when everyone else was taking losses. And that took a long time for the SEC to respond to him. Also made me think of, I know I watch Jon Stewart's show a lot. I know that he once took Jim Cramer, the guy from Mad Money, to task for telling people to buy Bear Stearns, I think, a couple of weeks before that went kaput. So it's not surprising that I think a lot of analysts, they want to sell winners, they want to pitch winners, and they want to find stocks, companies that are winning, and inspire people to continue that herd mentality. So unfortunately, it's depressing, but it's not really surprising that the SEC and analysts would respond this way to Cohode.
I think the difference between the SEC and analysts is the SEC works with very limited resources, and they also have to do a lot. They have to do a lot of other things other than just investigate companies. They have to, monitor the exchange and do all these other things. So, even if somebody brings something up to them that has some clout, at the end of the day, they have to allocate where they should spend their time. Whereas analysts are pitching and saying, you should buy this. The general public, they should do their due diligence when they're telling someone to buy something. Great point you brought up with Jim Cramer. I was going to say the same thing.
I think with the SEC, one thing with hedge funds, usually they invest a lot of money and make it on small percentages. So I'm sure the SEC gets a lot of hedge fund managers that call in with this type of information, where if all of a sudden the story comes out that the SEC is just looking into something, even if there isn't something, the stock might dip and they could make money just on this false information. So in the back of their mind, they have to probably think that they might get some of those cases. And then in terms of the analysts, I think it seemed like a lot of them were kind of blinded by the dividends. They saw that Novastar was constantly paying out these dividends, so they didn't want to be the ones to kind of go against it, where everyone else was kind of not as much.
All right. Anybody else have anything that want to throw in before we end the Hangout? I guess one of the things that I was thinking of is, so what approach could we take, or what does the industry need to have a more objective approach for analysts to be more objective, instead of just reporting a lot of those gainers, instead of following the gainers to because those companies do get a lot more exposure than those who are on more of the sell side analysts. So what can we do as an industry to, or what can analysts do to promote or to follow companies that are more on the downward trajectory? Anybody have anything before we wrap up?
I think there should be more of a due diligence on the analyst's part to actually provide accurate information and to provide a clear picture. I think one thing that happens is people look at the companies and the company's public image versus the actual data, and that is creating part of the problem.
All right. All right, excellent. Thanks, guys. Appreciate it. I'll go ahead and close this video and post it to our conversation. So thanks, and we'll talk to you guys later.